Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to the final episode of our 2025 Outlook podcast mini-series. I'm Steve Brice and I'm joined by Audrey Go, Head of Asset Allocation here in Singapore. Today we'll dive into our 2025 capital market assumptions and the outlook for our multi-asset income strategy. So Audrey, let's get started straight away. So can you explain what capital market assumptions or CMAs are and why they are important for investors?
Sure, Steve. So CMAs are long-term projections, typically 5 to 10 years, and we use 5 years in the bank, of asset returns, volatility, and correlations. Now, they are not precise forecasts, but they do provide investors with a framework for understanding long-term market trends and in building diversified portfolio. For example, over the next 5 years, we expect global equities to deliver 7% annual return, while bonds may yield about or return about 5%. So these estimates or long-term estimates help investors better align their strategies with their long-term returns objectives.
Okay, so capital market assumptions are essentially a roadmap for positioning portfolios to weather long-term trends. Given the shifts we've seen in recent times, so obviously inflation being higher, interest rates being higher, what's the broader impact on financial markets and on your capital market assumptions?
Well, great question. So the past 2 years have reshaped the market environment quite significantly. Bond yields have normalized to higher levels, and inflation risk, as we speak today, still remains elevated. And of course, there are also ongoing political uncertainties. So one of the key changes in our CMA is the shrinking gap between the expected returns for riskier assets like equities and credits versus safer assets like government bonds. And this reflects, basically higher bond yields boosting returns for safer assets, while expensive valuations weigh on the riskier ones.
Okay, so that's a decent shift there, right? So investors may not be rewarded as much for taking on additional risk. Can you explain why expensive valuations are such a challenge now?
Yeah, absolutely. So over the short term, valuations generally aren't that reliable as market timing tools, but they can stay elevated. So they can stay elevated as long as fundamentals are supportive. But if we look over a longer term horizon, 5 years or 10 years out, high valuations tend to drag on returns. So take the US equities, for example. They have performed well recently, but valuations are also nearing historical high, and historically, this has led to subdued returns over the next decade. And similarly, if we look at the credit markets, spreads are now near historical tights as well. So while the absolute yields are high because of the high elevated policy rates, it may suggest less room for outperformance from a credit perspective once spreads eventually normalize.
Okay, so if safer assets like bonds now look more appealing, should investors reduce exposure to equities and credit?
Not necessarily so. If we look at in the context of a portfolio, both equities as well as credit will still play critical role in diversified portfolios. For instance, equities are essential for long-term capital appreciation because they do benefit from growth, economic growth, as well as structural trends such as productivity gains from AI. And while US valuations are high, it is also justified to some degree by the much higher quality companies available there and also the high returns on equities generated by the companies in the US. And if we were to look out of the US, outside the US market, for example, valuations do look more reasonable and therefore can offer some opportunities for investors for diversification. So ultimately, what we see is a mix of equities, credits, and bonds will basically help investors to create resiliencies needed in the portfolio to better navigate market uncertainties.
Okay, so that covers the sort of the normal areas of asset classes, I guess. What about alternative investments such as hedge funds, private equity, and real estate?
So alternatives remains very key still for diversification as well as returns enhancements, especially in this volatile environment. When inflation risks are high, the usual bond equity correlation can break down. And in this scenario, alternative assets such as in private markets or hedge funds, for example, they tend to provide stability to the portfolio because they also tend to be less correlated with public listed assets. And additionally, private assets, in terms of returns, often also outperform public ones, so making them pretty valuable from a portfolio perspective.
Okay, so let's shift gears a little bit and talk about multi-asset income, right? So I guess for so far we've been focusing on a sort of a growth strategy more. This is now we'll talk about income strategy. So this delivered strong returns in 2024, around 8% returns. Can we expect a similar performance in 2025?
So 2025 will bring its own set of challenges, but there are three key takeaways, I believe, for income investors. The first is yields on income assets, particularly in bonds, may decline as central banks shift to a cutting cycle instead of hiking cycle. And one way to maintain returns in a falling rate environment is to consider reallocating from cash and short-term securities into assets that provide higher yield, better yield, but potentially may come with higher credit risk. So, for example, by shifting from cash to bonds, government bonds to corporate bonds, or even investment grade bonds to high yield bonds, these sort of shift will typically offer some yield pickup for investors. And of course, investors can also consider longer dated securities, longer maturity securities, which also typically offer higher yields compared to short term cash as well as short term bonds. The second thing is that the higher yield on offer is actually great for investors because higher yield basically provide a cushion. So even if bond price were to fall because of yields moving higher, for example, the fact that coupons are higher means that it can now better offset losses in terms of price loss and therefore supporting positive total returns. And then the final point is for income investors, the importance of reinvesting income because by doing so, it can help to enhance total returns. For example, since 2014, just using this as a potential case, if we were to reinvest all the income from our multi-asset income strategy, it would have added over 30 percentage points to returns compared to an investors who regularly withdraw income and don't reinvest them. So there is no right or wrong to either approach, but investors should basically align this decision with their objective, whether they prioritize cash flows on a regular basis or in terms of long-term growth in their portfolio.
Okay, Audrey, thank you so much. That's a great way to frame the conversation and wrap everything up from the conversations we've had with other team members. Thanks for your insights and actionable advice. Um, Thank you, listener, for listening in to us over this mini series. We hope you found it useful, whether you're starting on your investment journey or making tweaks as you go along. Please rate, like, or follow us on our different social media platforms, whether it's on Standard Chartered Money Insights podcast channel or Standard Chartered Wealth Insights on YouTube or LinkedIn. In the meantime, I wish you a fantastic festive season. I hope you manage to get time with your family and your loved ones. And we look forward to speaking to you again in the new year. Please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.